Today on Your Money, Your Wealth, we're talking cap rates, net operating income, and cash on cash. It's a nuts and bolts, bread and butter real estate investing discussion. How do you identify a profitable rental property? Should you pay the mortgage, buy more real estate, or save for retirement? Can a property that isn't actually a rental be considered one for tax purposes? Is it a good idea to buy a home with cash? Real estate then dovetails into saving for college. Should you refinance your home to pay off student loans? What can you do with unused college savings funds? Plus, find out what palm trees and ornamental corn have to do with education costs, why listener Earl wants to give Joe a big old bundle of cash, and what the fellows have against 72T early retirement withdrawals. I'm producer Andy Last, and here to answer your questions are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
We get a lot of questions on real estate.
We do.
You've been an investor for quite some time now.
Yeah, I like real estate. I always have.
You know, some of you are writing us like 14 pages of questions, which is awesome. But if you've ever listened to this show, I read the questions, and it's sometimes very painful to listen to and for me to read it. So you can just click on the button that says, you can just talk. You can just ask your question.
It says record a voice message.
Yeah, I do agree.
Yeah.
When you've got a long question, that's a much better way to do it.
Yeah, because then you can, then we know what you're talking about.
Yeah, right.
Sometimes they write in their personality.
Yeah.
And I screw that up.
Right.
It'd be
And
nice
because
to
your
hear
personality goes over theirs.
Well, yeah.
Totally gets in the way.
It totally gets in the way. So do that. That would be fun for us, and probably for all of our listeners. Okay, we got Brian. He writes in from San Diego. Now, Brian, I want to see. I just told you. I just blow these things up. This is like just a couple sentences.
We're just getting started.
I know it. I want to better understand my options for investing my money into real estate. I currently own 2 properties and rent one. I have $120,000 saved and want to put that money to work. I could pay off my condo or purchase another property. What's your thoughts, Big Al?
I love the question. That's pretty open-ended, too. So, Brian, in San Diego, as Joe and I are also in San Diego. So here's the thing about San Diego real estate is it tends to be pretty expensive relative to what you can rent it for. So it's really tough to get a decent cash flow. In fact, it's tough to get any cash flow. Usually it's a negative cash flow.
I like how you just put that.
Yeah.
You're like, yeah, Joe and I live in San Diego.
Yeah.
It is very expensive to live here.
Oh, is that how I said it?
It sounded like that.
It's really exclusive.
Yes, it is.
At any rate, so let me give you a couple thoughts. Now, you've got 2 properties already. You're probably living in one and renting the other one, I'm guessing. And so good job. So when you're renting a property, it's of course a couple just quick things. One is it's cash flow. How does the cash flow look? And when you look at a potential property to purchase, look at it from all different angles. Because you own a rental property, you probably understand this, but for those that don't, it's not just the rental income coming out and the mortgage. There's a lot more expenses. There's vacancy. San Diego, for example, has on average about a 5% vacancy factor, so make sure you throw that in. Now, you may not have any vacancy for a year, but you might have a month the following year.
Hey, why don't you walk through the math? Because people might hear cash flow or cap rate. Or,
right. Okay.
To examine, because if I buy a rental property, how do I know that this is a good deal?
Yeah. Okay. Good. So let me just start with the rents. You subtract out obviously the mortgage, but then like the vacancy. There's property taxes, there's maintenance, there's homeowners fees if it's a rental property. There might be pest control, there might be gardener, any number of things. So basically you start with your rent, you subtract out all your expenses, and you come up to a bottom line profit or loss. Okay? So let's just say, real simple example, $100,000 property, and you get $10,000 in rents, and your expenses are $6,000, let's just say. So your bottom line profit is $4,000. Okay, so now you look at that $4,000 and you divide that into the property.
Do you divide that into net equity or market value?
Yeah, it's both. Let me do both. Actually.
Okay.
Let me start with the property itself, and that's called cap rate. So it's the bottom line profit without regard to the mortgage interest and principal. So without regard to your mortgage, so in real estate investor term, they call that net operating income. It's the rental income minus all the expenses before the mortgage. Okay, you do have to add property taxes, but it's that net number. You divide that number into the total property value. That's cap rate. And the higher the cap rate, obviously, the better the cash flow. If you've got a property that has a 1% cap rate, that's really low. That's a very poor cash flow.
So then you look at your opportunity cost.
Yeah.
It's like I'm getting 1% cash flow on this
Right.
property. Where could I reinvest that into a CD and get 2.5?
Yeah, exactly.
Without
right.
all the hassle.
Yeah, exactly, right. Now, of course, the flip side to that is what if the property has high appreciation potential? So obviously that's what you look at. And that's what I was sort of getting to in San Diego. We tend to have not very good cash flow here, but good appreciation potential. And that seems to be true on the West Coast and the East Coast. And there are many other places too. But then there's a number of places in kind of middle America where it's the cash flow is better, but the appreciation doesn't seem to be as much. It can work either way. But so that's the cap rate. The other one is cash on cash. And cash on cash is simply how much profit do you have from that property relative to how much your equity is.
How much
in the
cash
property.
you have in it.
Yeah. So in my example, if you have $4,000 of profit after the mortgage, and you had a
$50,000 mortgage.
yeah, $50,000 mortgage, $50,000 equity, right?
Mm-hmm.
So what's that? 4 into 50? Now you got to challenge my math, but somewhere around 8%,
Yeah.
8 or 9%. That's really good. That's really good. And in fact, in higher appreciating areas like San Diego and West Coast, East Coast, if you can get anything close to 4, that's really good.
So even though the house might look like a dump, right?
Yes.
And in a terrible neighborhood, but if I look at cash on cash, or if I look at the cap rate, it could be a pretty good investment.
It could be, and I have a couple more observations based upon what you just brought up.
But on the flip side, people might look at a really nice home
Yes.
with all brand new furnishings,
Yes.
Beautiful backyard in a wonderful neighborhood, and the cap rate in cash on cash is terrible.
Correct.
Because you should be living in that
Yes.
versus renting that.
And I would say that, and that's a good observation. In most cases, there's exceptions, of course, but in most cases, the places that have good cash flow that would make good rentals are not necessarily the place you're going to live in and raise your family.
Sure.
Not that they're not.
Someone else will.
Someone else will. Yeah.
And pay you to do it.
If you've got the investable assets to invest in real estate, in general, you may want a little bit better place than what I would call a bread and butter rental. Just kind of a starter family home and kind of a decent neighborhood, not a slum. So yes, so it's probably in general the places that you rent will not necessarily where you want to live, but you also have to look at where you do buy a rental. It's like those properties or that community, is it up and coming or is it declining? And you're actually looking for a community that maybe has had some problems, but now it's kind of up and coming. Maybe it's kind of a center city community that's now, because there's so much growth in the city, that people are coming in, they're improving their homes, the community's going in the right place. Maybe there's a new employer, or if you see a new Home Depot in an area, sounds kind of funny, but that's actually a really good sign that this is probably an up-and-coming area, even though it may not look that great at the time.
So hopefully that helps you out, Brian. Another thing I just thought of too, Alan, anytime you, I guess, debate about one investment that you should go into, there's a formula, because there's cash and then there's growth.
Right.
Right? So you got to look at the growth aspect of it, plus the cash flow aspect of it, plus the tax benefit that you would potentially receive from
Correct.
it would equal your total return.
Yeah, and one quick thing about that, Joe, is if you put 100% down payment, which usually you can't do, it's too expensive, but let's just say you do, $100,000 property, you put $100,000 of your own cash in. If the property goes up 5%, then you've made 5% on your money. But if you put a 10% down payment down and the property goes up 5%, you've made 50% on your money. In other words, the property doesn't care whether there's debt on it or not.
Right.
If it's $100,000, it's worth $105,000, and you only put $10,000 down, now your equity is $15,000. You actually made 50% on your money. And of course, that's way oversimplification, because there'd probably be negative cash flow in that case and a lot of other things. But that's how people make money in real estate, is by using leverage or other people's money. It's also how you lose a lot of money, because if you put $10,000 down and it goes down, the property itself goes down 10%, you've lost 100% of your investment because you have zero equity.
Yeah.
Yep. So just remember, it works both ways.
If you're considering making an investment in real estate, I have crammed the podcast show notes at yourmoneyyourwealth.com with a ton of free resources. You'll find Big Al's video with 3 tips for beginner real estate investors, his blog on Real Estate Investing 101, and a previous podcast episode on using rental real estate, specifically small apartment buildings, to build legacy wealth. I've also thrown in past episodes on other potential real estate investments like vacation rentals, mobile homes, and raw land. Plus, exclusively in the show notes, and especially for our San Diego-based aspiring real estate investors, you'll find video of Joe and Big Al discussing cash-flowing rental real estate here where we are in the San Diego market. There's also a free white paper with 10 tips for real estate investors waiting for you as well. Now, while I was telling you about all those free resources, which you can get by clicking the link in the description of today's episode in your podcast app, Big Al left the studio. He joins us now via Skype.
Alan, how are you, sir?
I couldn't be better, Joseph. and you know why? Because I'm 3,000 miles away from you in Hawaii.
Oh boy! All right, rub it in.
So it's a great day.
So any day 3,000 miles away from me, it's a great day.
Yeah, I could be at a prison. It'd be improvement. But actually, I'm sitting here looking from our living room. I'm looking at a really nice grass lawn, the ocean, and I see some whitewater and some palm trees.
Wow!
So yeah, this is better than a prison.
Got it.
Yeah.
All right. Well, let's start answering some questions.
Yeah, we still have a lot of questions, don't we?
Yeah, we do.
Yeah.
Since you're in Hawaii, we got Tom. He writes in from Oahu, Hawaii.
Yeah, he's we're up near brothers. I could wave to him almost.
Yeah, you probably could. I've listened to your show.
By the way, I'm just for Tom's benefit and our other listeners, I'm on Kauai. It's not right around the corner from Oahu, but it's in the vicinity.
Well, you can swim there.
It'd be a long swim, but I could try. I might need to be rescued after about 20 minutes.
Maybe you should try, Al.
I should?
Yeah.
Tom, be ready to rescue Al.
Tom, can you have a boat set up for
yeah.
me? Because I'll get probably, I don't know, 300 feet off of Kauai.
Do it at night, too. That'd be helpful.
No. Yeah, that's when the sharks are more active, probably. Yeah.
All right.
Yeah.
So Tom writes, I have listened to your show for the last few weeks, and especially the recent show that included Al's description of veganism and discussion of Chinese restaurants.
Wow. I remember talking about veganism. I guess I don't remember talking about Chinese restaurants, but maybe I did, because they have rice. Rice works just fine for me. Rice and noodles with some veggies, I guess.
All right. We live in Hawaii and noticed that Al seems to know quite a bit about the Aloha State.
True. Very true.
So if he ever comes over to Oahu, he's welcome to stay at our waterfront home. We could grill and watch sunsets together while we pepper him with tax and retirement questions. So
wow, that's next week's show. I'm going to be at Tom's house.
All right.
Yeah.
So here's his question. My wife, 41, and I, 45, are stingy professionals that love to travel, have no children, save some money, and have not invested or put anything into retirement. My wife is a university employee that offers 403B, 457, neither's matched. We have a small LLC that I work through, but it only has about $20,000. Her income is around $120,000. We are 8 years into a 30-year mortgage of $312,000. House is worth about $1 million. Also make about $40,000 in passive rental income. So we have about $70,000 in saving that just sits in bank accounts. Financially, we are stable, but my wife may want to quit her job to travel more and concentrate on our LLC and make our income through a consultant rather than her job. We have been saving money in the bank in case one of us gets sick and we need an emergency nest egg to pay off the mortgage or medical payments. Is having this nest egg sitting in the bank a bad idea? If so, what should we do with our future tax years? In what priority? So pay off the mortgage is question number one. Put money into the 457 plan or 403B plan, or something else. Aloha, Tom.
Aloha, Tom.
So what do you think, Al?
Let's summarize. So they're 41 and 45. They love to travel, have no children. They save some money. They have 403B, 457. Neither is matched. They've got the mortgage at 312. They have about $70,000 in savings. They don't really say how much is in the 403B or
I don't think they have
457.
anything in the 403B.
Yeah.
They offer
Okay.
it, but they're not taking advantage of it.
They're not taking advantage of it. So I guess they're relying on the university pension.
But she wants to stop working. She's only
Yeah.
41.
Yeah, that makes it tough. Yeah.
So he's got some passive income of $40,000 from some rentals.
Yeah.
So that's probably through the LLC. She makes $125,000. So what, to replace $125,000 of income, you need a lot of assets to produce some passive income to create that type of income.
Yeah, they need about 1.2 million.
Yeah, well,
Give
more
or
than
take.
that.
Oh
Yeah.
yeah, I'm in Hawaii. I'm not thinking properly. It's double that.
Yeah.
It's close to 2.5.
Yeah,
right?
probably close to 3. Yeah, depending at 41
Yeah.
and 45. Yeah.
Yeah, it depends. If the passive income is reliable, you wouldn't need quite that much. But still,
Sure.
Here's my first comment: is when my wife retired to work on our rentals and LLCs, that didn't last long. So I gave it to Robbie. So just be aware. It may be a little different when she retires. That's the first piece of advice I have.
So I don't know. I think Tom needs to run some numbers a little bit because that income's quite a bit. His income's $40,000. They got a mortgage of $312,000. They got $70,000. Keep the money in cash. You need a cash reserve, so it's not like taking the $70,000 from savings and start investing it. I would start, by funding retirement accounts. I think that's a good idea. If they want to retire earlier and live off of passive income, well, then you got to pay off debt. You got to reduce, I think, the monthly nut, so then the passive income doesn't have to be as high. So it's a tough one.
It's a tough one. I think the way we sort of look at it is if her income's about 120, and we don't know what their spending is, but let's just say the spending's 120, and so we would say, Tom, you probably should have at least 6 months emergency fund, so that would be $60,000 at least right there. So that means the $70,000 in savings should just be in savings for the reason, Tom, that you've identified, which is in case something happens to either you need the emergency cash. So you can't really invest that. And I do like the idea personally of adding to retirement savings before paying off the mortgage. I think the way I would think about it is once you have your emergency fund, I would get to the point, if you could, max out the retirement accounts, and then if there's still extra that then if you want to pay a little bit more towards the mortgage, I'm okay with that. But I think I'd sort of go in that order.
Yeah, the 457, I would start there because you have access to the 457 at any age, Tom. So if you do lose a job or quit work or do whatever, you do have access to the 457 plan at any age. So your 403B would be subject to 59.5, just like an IRA. So,
hey, Joe, question. What are the differences in investments between a 403B and 457, or are they pretty similar in general?
In general, they're pretty similar. The 457 is a non-qualified deferred comp plan in a sense. So, but it's just usually it's ran by the state, and they have a certain provider that provides the 457. So it could be the almost identical to the 403B, or it could be a little bit different. But in most cases, right. I mean, it's 6 and half a dozen. All right, let's go to traditional or Roth. We got David. He's writing in from El Paso, Texas. He goes, "Hi, Joe and Al, great podcast. I can't stop listening."
Neither can I.
Oh, God. David. I suppose in El Paso.
Well, and Andy, I'm thinking you have to listen.
Yeah, I don't have any choice.
Yeah.
Anyway, we don't have a traditional home. But what the hell? What is a traditional home? But for simplicity's sake, we say El Paso, Texas.
I bet you that they're in a motorhome or something like that.
I'm 50. Oh, so like they travel.
I bet that's the deal.
Oh, that's badass.
Yeah, right. That's what I want.
Yeah, he's all over the place. He's just living the dream. And then,
that's my guess.
But he picks El Paso, Texas. Why wouldn't you say you? I would.
You might have family or something like that, and that's home base. But the rest of the time, you're in Hawaii.
Go.
Well, I know why he did Texas, because there's no state tax.
Got it.
I don't know why he picked El Paso, but Texas that's not a stretch.
All right. So, David, he's 50. His wife's 53. And I have a question about retirement. We both work for the same company. Dipping in the company ink.
Oh, I wonder if they met there.
I'm sure they did.
Yeah, right.
You guys are such gossip mongers.
Guaranteed. They were on the
well.
copy machine or something.
Yeah, I was thinking coffee, but you went to the copy machine. That's even more interesting.
Oh, yeah. All right. And they both have the option of choosing either a traditional 401k or Roth 401k. We have around $100,000 that we can invest each year. Wow. We would like to buy a house, $300,000 range, in 5 to 7 years and pay cash. My plan was to max out our 401ks using the Roth option, which would amount to roughly half of our available annual investment budget, and then take the remaining $50,000 and invest in a brokerage account to fund our future home purchase. We are able to contribute $2,000 per week. After listening to one of your podcasts from last year, though, you had mentioned that you love to see accounts in thirds, which I understood as 1/3 traditional, 1/3 Roth, 1/3 brokerage, as it offers more tax flexibility. This made me wonder if it's something we need to consider since we're starting from zero. Should one of us max out the traditional and the Roth 401k? Should we both max out Roth 401ks and no traditionals? Should we each max out Roth IRA and reduce the amount we put in the brokerage account? We started our retirement savings late in life, but I think we put ourselves in a position to catch up at least a little. I just feel like we've got one shot to get this right, and I'd like your opinion. Our account are at zero now, as we spent the last year paying off our debt. Our plan is to invest $100,000 each year for the next 10 years, and then we'll slow down a bit. Okay? So you want to hear the backstory, Al?
It explains what their non-traditional living situation is.
We both decided to quit our day jobs. Me, manager of a mid-sized manufacturer, wife, supply chain manager for a tech company. Sell our home in just about anything that wasn't sentimental. Went to CDL school and became a professional driving team. Wow. What the hell is CDL school? Professional driving
commercial
team.
driver's license.
Oh.
Wouldn't that be what it is?
So they're like truckers or
I think
something.
so.
Yeah,
that's even better.
Right.
Yeah.
Yeah, that's a great job.
After spending the last year paying off considerable debt, we're able to live on $20,000 a year and put about $100,000 towards retirement. Bonus, we love it. I wonder what his call name is.
Smokey and the Bandit?
Right? Like Rubber Ducky or something. That's awesome. All right.
Yeah.
Okay,
yeah.
So they can save $100,000 a year, 50, 53. He's going, Roth, 401k, what the hell do I do? I heard a third. So he's kind of getting information all over the place. From us, that is non-consistent. Imagine that.
Yeah, never happened with us, right?
So they want to buy a house in 5 to 7 years and pay cash, $300,000. If they can save $100,000 a year to do that, I don't know, Al. I'm thinking, let's start with a house. I think it might make sense for them to have a little bit of a mortgage, but paid off in 5 to 7 years. You know what I mean?
Right.
Interest rates are really low. Instead of putting $300,000 cash today, get a mortgage for $200,000, put $100,000 down, and you pay a few $1,000 or maybe $1,000 a month on a small mortgage, but then you have the other, $80,000 per year that is working for you. And then at some point, if you ever want to pay the mortgage off, you can accumulate enough liquid assets over the next 5 to 7 or 10 years where you would have that option.
Yeah, that's not a bad idea, Joe. Although it sounds like they're on the road a lot, and so maybe they don't even need it. Maybe they could even rent it out for some extra income as well. So that could be a possibility. But I think interest rates are really low right now, like you say, although real estate is high. So who knows what it's going to do? It could flatten out. It could keep going. It could decline a bit. So if you're of the opinion, and I don't know much about El Paso real estate, but if you're of the opinion that it's peaked and you think it may come down, you might wait. But that's timing. And, we're not too interested in timing. It's very hard to time markets, real estate included. So I think I would probably favor the home too, and with a mortgage, with a low mortgage. And then I would probably let's say they're living on 20,000 and they got 100 that they can invest, and their taxes are 20. Maybe they make 140. They're probably in the 24% tax bracket with no state tax. And I like the fact there's no state taxes. So I probably would have at least some go into the Roth. I don't know if it's a third. What do you think, Joe?
No, I think they're in the 22% tax bracket at 140 even. So I would go 100% Roth, to be honest with you. I'm a big fan of that at 22% tax rates. Because the reason why we want to go a third, or break it up for tax diversification is because most people have 100% of their liquid assets in a tax-deferred account that's going to be taxed at ordinary income. If you can forego a little bit of tax savings today, which is not going to be huge at 22%, and then accumulate all of that money into a tax-free environment, I like that the best.
10-4, Rubber Ducky. By the way, if after listening to the YMYW podcast and perusing all of the real estate investing resources in the show notes at yourmoneyyourwealth.com, if you still have questions about real estate investing or any other money topic for that matter, you can always click the Ask Joe and Al on-air banner at the top of the show notes and send in your questions as a voice message or an email, and I will get them straight onto our list of emails. How do you get to the show notes, you might ask? If you're hearing this right now on Apple Podcasts, Google Podcasts, Stitcher, iHeart, Pandora, Spotify, CastBox, Overcast, or any of the other podcast apps, you will see a link right at the very end of the description of this episode. If you click that link, voila, you are at the show notes. From that page, you can send in your money questions, you can read the transcript of the episode, sign up for the podcast newsletter, and access all those previously mentioned free resources. Then, the best way to say thanks for this great show is to share YMYW with all the other people you know who would enjoy it. You can do that right from the podcast show notes as well.
We got Matt from Minnesota again. Man, these guys take advantage of us, Al.
They like to write over and over.
This is our dedicated, loyal audience. We love them, Joe.
Yes. Odd question Matt's got. I have 2 properties besides my residence that I own free and clear. But neither of them are technically rental properties. One is being used by family that we know that has fallen on hard times. The other is being used by my son. In both cases, there is no rent being paid. Is there a way to structure this setup to save money on my taxes? Can I treat them as rentals that are losing money? Not sure what the best setup would be. Thanks. All right, Al, you're the real estate guru.
I will take that one. Matt, there's very little you can do on that to create a tax deduction with one exception, and because they're not rentals. And I'll get back to that in just a second. You can treat one of them as a second home, and as a consequence with a second home, you could write off property taxes on your Schedule A. Of course, those are limited to $10,000. Maybe there's not that much benefit. You said the properties are free and clear, so you don't have mortgage interest. But on a first property and a second property, you can write off mortgage interest and taxes. Now, the fact that it's basically they're being rented to family, or maybe they're basically given to family with no rent. It's not a rental if there's no rent, or even if there's below market rent. In some cases, maybe a family member will rent to another one, and the fair market rent's $1,000, and they're charging $500. So that's a below market rent situation. You can deduct rental expenses, but only down to zero. You cannot create a loss when the rents are anything lower than fair market value, which would be the case here. So unfortunately, that's not a great answer, but that's the rule.
How about this, Al? So his son's living in the house, and maybe his son is married. So how about if rent for the year's $30,000? The son's not paying the $30,000. Matt is gifting the $30,000 to his son. Can that work? Because like you can do $15,000 per year per child, right? So
yeah.
So let's say Matt's son's married, so he's going to give him $30,000 as a gift. Then Matt's going to give it back to him in form of rent.
Rent payments, yeah. So in that particular case, the whole $30,000 is income, and if that is considered fair market rent, that could possibly work. Sometimes, though, what happens is people don't give a lump sum. They just say, "Well, let's pretend it's $1,000 a month or $2,000 a month, and we'll just do it on paper," and it just kind of runs amok because it really does look like a gift related to the rental. So if you're going to do a strategy like that, you'd want to do like a one lump sum that wasn't at all tied to the rental. In fact, you'd want the amount to go to the son, not the sum of 12 months rental payments, some other sum. So it looks like it's something completely different. So that could be a possibility. But remember, when you have a rental, in a lot of cases, your rental income, your expenses, they may be a little bit lower than the rent, or certainly in California, the expenses are pretty high. And with depreciation, you can create a loss, but that reduces your tax basis. So when you sell the property, you got a higher capital gain. So you may not benefit that much, really.
Yeah, it probably doesn't at all. So, all right.
Yeah, because I think by the time you create a loss of a few $1,000s, you've reduced your basis by 10,000. I'm just guessing, and so you got a higher capital gain later, which may not be worth it.
All right, on the same kind of thread here with taxes and gift tax, we got Earl. He writes in, Big Al, question has come up about tax liability on a cash gift exceeding yearly exemption of $15,000. Say I give Joe Anderson $25,000. Wow.
Do you know Earl?
No, I love Earl now. I like where his head's at.
Yeah, it's interesting.
Is it the first $15,000 exempt? The overage is, this example is then reported on IRS Form 709, I believe, in the amount of $10,000, then reduced from my lifetime estate and gift tax exemption, which is $11.4 million. I keep being told by others that I'm wrong. The overage is, in this example, is subject to tax this year. I think there's no tax. The amount over just reduces my lifetime limit. Not likely any tax ever with limits north of $11 million will ever be due. Who's got it right? Have listened to both of you for years. Fantastic service you provide, but it's time to put together some new shows for Sunday morning. Maybe
I agree with that.
A piece on this often must understood tax. Thanks. All right, Earl, we are taping season 5. Six. It feels like season 60.
Yes, it does.
So yeah,
we had a long hiatus, but we're back. We had to get a new studio, which we now have almost ready. So I think our first new show will be coming out maybe in about 6 weeks or so.
Yeah,
give or take.
Couple weeks, Earl. But
yeah, just hang on. And so I guess if I'm going to answer the question, Earl, I'd like you to give me the $25,000 gift instead of Joe. Let's start with that. But anyway, I will tell you, Earl, you are correct. There is no current tax. You file a Form 709, which is a gift tax return. It does come off of your exemption. Of course, the IRS never makes things simple. It actually reduces your unified credit, which is a different number. But for our purposes today, it's just like it comes off your exemption. So you can think of it that way. So in other words, if you were to pass away, then you don't get the $11.4 million exemption. You get the $11,390,000. Right, which is probably enough for most people.
All right, Mary Jo writes in from Carlsbad, California. Would it be wise to refinance my home? I have equity to pay off my son's student loan of $40,000. He could pay me back, and I would deposit it back into the principal each month. Thank you for your advice. What do you think there? Would you rather hold the student loan or refi the house and have the kid pay it back?
Well, hopefully the kid can pay it back. I kind of hate to do that because, you sort of hate to have family loans if you don't have to. And in some cases, student loans, they have provisions where you can make lesser payments if you get into trouble financially. Mm-hmm. So, which is not true of a home equity loan. So, I don't think I would probably recommend that. However, it's $40,000. It's not.
It's not $400,000. You know what I mean?
Yeah, it's not the worst idea ever. It's just I probably, with what little I know, I probably wouldn't necessarily recommend it. But if you want to do it, I'm not going to lose any sleep over it.
Yeah, I agree with you 100%, Al. Because there's certain things that you would definitely want to keep, depending on what type of student loan it is. Versus rolling it in your house.
If it's a loan that's really high interest rate, and you can get a low interest rate home equity loan, and your son has good income, and you trust him, and there's not this issue about needing to get lower payments. Maybe it's not a bad idea.
As this episode morphs from real estate investing and leveraging your primary residence into how to pay for college, I've added some resources on that topic in the podcast show notes too. Check out our webinar on how to save for college. Find out whether you should save for retirement or your kids' education first, and watch How to Make College Affordable on YMYW TV. Visit the podcast section at yourmoneyyourwealth.com to view today's show notes, or click the link in the description of this episode in your podcast app.
We got Jared. He writes in from Greenville, South Carolina. I'm considering planting a 7 to 10 year payoff crop. What?
He's a farmer.
Okay. I'm considering planting a 7 to 10 year payoff crop as a hopeful source of college funding for my son. He will be 18 in 10 years, and the crop I'm considering will be mature and ready to sell. I foresee that the profit from selling this then may
astronomically increase my income tax rate.
Hold on. I foresee that the profit from selling this then may astronomically increase my income tax rate. Then it's lumped up with my day job earnings. I'm curious if what it is time to sell the crop. God, he can't write. It's not my fault. I can't. Or is it me reading?
It's you, Joe.
No, it's
It
not.
is you.
It is not me.
I am curious if when it is time to sell that crop.
It will in kind of whatever. That's what I'm reading.
That was not English.
I know. I can read
This
English.
is all you, Joe. This is all you.
It's Jared's accent is coming through his writing. I'm curious if when it is time to sell that crop, my son can report it as income for himself and pay taxes at a more reasonable rate that way. This needs to be done totally legally. How could I navigate this? Relax over there.
I'm thinking, Joe, I think you're over 40. You may need some reading glasses. I'm thinking that's the thing.
It could be. It could be.
Yeah.
Or at least contacts, because I know you're vain.
Yeah, right. So, Jared, I am very vain. Jared's got a crop. He's thinking about planting something, and then this crop is going to mature in 10 years, right in time for his kid. Then he wants to sell the crop. He's going to have a massive, astronomically profit to kill his tax rate. Can he just give it to his son, and the son pays the tax? I think there's a kitty tax involved here.
Well, no. The answer to the question is no. However, here's a workaround: is if your son is involved in the harvest of these, I'm assuming they're trees because they take 7 to 10 years. I'm going to assume South Carolina, maybe they're palm trees. I'm going to add some color to this email.
There's palm trees in Greenville, South Carolina, huh?
As a crop, there might be.
All right.
Yeah. Maybe it's pine trees. What do I know?
Maybe it's Christmas trees.
I don't know. I was thinking corn. But I think that's
I don't
probably
think it takes 7 to 10 years to grow.
No.
This is why you are a financial planner and not a farmer.
That would be pretty rotten corn. I don't think you get astronomical increases.
Maybe it's special corn.
But here's the workaround. Upon harvest, you get your son involved in the harvest and you pay him. And so that's a deduction. That could be contract labor. It could be salary if you want to go the employer route. And that way you can transfer some of your profits to him. But that's completely legit as long as he's doing the work that you're paying him for.
Very good, Al. All right.
Yeah, I like that.
I like it. I like it a lot. All right.
You think you're still thinking it's corn?
No.
Maybe it's the corn that you get in Thanksgiving that's all like hard,
yellow and
petrified?
orange. Yes.
Petrified corn.
Yeah.
Maybe it's that.
Isn't that stuff only used like for decoration?
Yeah. Well, maybe that's what he's doing.
Maybe.
Yeah.
Probably takes 7 to 10 years to grow.
There you go.
Then he's going to go to Walmart.
Yeah.
Astronomical profits.
And Walmart's going to say, I'll give you 5 cents an ear.
Right? We got one from Marion. Oh, Marion writes in from Fresno, California. I don't know why I thought, well, Marion could be a name.
Could be a name. It is a name, Joe.
I mean, I don't know why. What I meant to say was, I don't know why I thought Marion was a place of where she was. Never mind.
Where she was from?
Yes.
She was from the suburb of
From Marion,
Yes.
Fresno.
Yes. All right.
Okay. Got
She,
it. Well.
so Marion writes in, when my daughter joined the Marine Corps, she signed up for the college savings plan during basic training. Later, she decided to make the Marine Corps a career. My question is, can she give away cash out of this savings plan? Anything besides try to use the money for education later in life? All right, so Marion has a 529 plan.
Right.
And so she was thinking,
Is it specific for the military, though?
Well, no, actually, when my daughter joined the Marine Corps, she signed up for a college savings plan.
For the college savings plan. That sounds like is that a military thing?
No. A college savings, 529 plan, could be Coverdale IRA. So the question is, can she get out of that thing without any penalties if she's not going to use it for education? The answer is no. You got to use it for education.
Yeah, but I will say, and I think a lot of people don't realize, let's say she put 10,000 in and it's grown to 11. The $10,000 comes back, no tax, no penalty. It's only the $1,000 of growth that you have to pay taxes and penalty on.
So maybe not be as bad as she might think.
Yeah, correct.
So, yeah, or they could gift it, right? So let's say the daughter has a child and they want to pay for the child's education. It depends on what kind of savings plan it is. 529, you can kind of gift from different generations. So we can answer that. And then Marion writes in again. She goes, after listening to podcast 255, remember that one, Al? That was a good podcast.
I
That was
dream
the
about that sometimes.
5-year clock
Got it.
on the Roth.
Okay.
About Roth IRA conversions, a half a dozen times I realized I'm converting a tax-deferred 457 plan to Roth IRA to take advantage of current low tax rates. Anyway, hope I understand correctly. Attached is my understanding of the podcast. See attached. Okay.
Oh boy.
So
Okay.
that it's hard to read
We went
this.
over that.
Right.
So I will send Marion that information.
And yes, the
Okay.
podcast is the best ever. I cannot remember how I find YMYW.
Your magic, your wealth.
Oh, your magic. Oh, got it. But have recommended it to my children and their friends. P.S. Marianne is male, Marianne is female until about 1950. Oh, boy. Here we go.
We get the whole history.
Yes.
But
Then,
we got John Wayne.
then
and
it all went to hell. All right. So, Marion Mitchell Morrison, known professionally as John Wayne, and nicknamed the Duke, again named before 1950. So, all right. Thanks a lot, Marion, for the questions. All right. Next in line, we got early withdrawal question from Roger. No location given.
Duke. Ooh,
Okay, Roger.
somewhere in the U.S. maybe.
We gotta get tight on the rules here.
He's on the podcast newsletter mailing list, and he just replied to the newsletter and for episode 257, where somebody had written in and asked, what are you supposed to do when you want to take money out before 59 and a half? So Roger is saying...
So he asked the question, hi, why didn't you mention 72T SEPP for the second question on IRA withdrawals before 59 and a half on podcast number 257? What do you have against these? Well, Roger, I
Joe,
got a
what-
lot of things against them because they suck. I hate 72T. No, the 72T is a code in the tax code, a section in the tax code. SEPP, separate equal periodic payments, is what that stands for. So if you are under 59 and a half, you can take money out of a retirement account, an IRA, without the 10% penalty, as long as you take the same amount of money out of the account each year for 5 years or till you turn 59 and a half, whichever is longer. There's 3 methods that you would calculate to figure out how much money that you can take from the overall account. I got in this business in 1998, I believe, was the year. And you know what happened in 2000, right? Remember 1998, 1999, 2000, was
I
like the
sure do.
dot-com boom, right?
You probably thought you were really smart.
Oh,
for a
my
couple
God.
years.
I thought I
I'm
was
guessing.
a genius.
this is easy, right?
Oh, my God. Yeah.
Every investment you picked went straight up.
Oh, yeah. Putnam New Opportunities Fund was up like 48%, and then it was down 70.
Yeah, right. Yeah, when it went down.
Yes. So it was right before the dot-com bust. And So there was a lot of younger executives that retired that have retirement accounts that were under 59.5 that wanted to use a 72T tax election to get money out. But I don't really care for it in a sense that you're tied to a certain payment that is, it could be for a substantial period of time. If the market drops, you still have to take the money out of the account. It's a separate equal periodic payment for 5 years or until you turn 59.5. It's not like we're not big fans or we have anything against them. It's just another tool that you could use. I don't know why we didn't even bring it up. Maybe we were just talking
That's his
about
question.
something. I have no idea. I forgot about it or something, Roger.
Well, we probably ran out of time. I don't favor it necessarily for the first reason that you said, which, like, let's say you do it at age 40. You got to do it till 59.5,
right?
Even if you have another job. So that may not be something that works that well for you. And the second reason I'm not crazy about it is the amount of payment that you receive is usually pretty small. And so if you could do another method like retire at age 55 and on a 401k, and then you can pull money, then it's kind of unlimited.
Yeah, without question, because I think they think they can get a ton of money out of their overall accounts, but it's almost like the RMD. It's like a couple percent. So
yeah, it's right. You got a couple 100,000. Maybe you can pull out $4,000, $200 a month, right?
Yeah,
so
right.
200 a month. It's
Yeah.
like that doesn't even pay the cable bill hardly. With all my 2,000 channels that I never watch.
So Roger, we got nothing against them, I guess, besides that we probably would never recommend them. So, all right, that's it for us today. Thank you so much for listening. Again, if you got a question, comment, complaint, whatever you want, go to yourmoneyyourwealth.com. We'll see you next week, folks.
We do have a couple of very quick derails at the end of this episode, so stick around if you like those. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the free assessment button at yourmoneyyourwealth.com and sign up for a no-cost, no-obligation 2-meeting assessment with a certified financial planner from Pure. If you're in Southern California, we've got offices in San Diego, Brea, Irvine, and Los Angeles. Or if you're outside of SoCal, your free assessment can even be done via video web meeting. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Got it. How do you say that, Andy? How do you say that?
6 of one and half dozen of the other.
Thank you.
Yeah.
Okay.
I used to have a boyfriend who would say half of one and 6 dozen of the other, or something like that.
Well,
and it
you
was
didn't
like,
get
no,
what
that's
I was saying?
completely wrong. You said
I
six.
said 6 and a half a dozen.
You said 6 or half dozen. That's not the
That's
complete
exactly
thought. He shortened it.
Yeah, just
Because he
shorthand.
thinks you're a hipster there, Al.
Which is it's called shorthand, Al. We're on a podcast.
Shorthand. Okay, I'm in Hawaii. I don't want to think too hard.
Yeah, 6 and 1/2.
Yeah.
You got
Yeah.
it. All right.
Yeah.
Okay. Aloha, Tom. You can stalk Big Al. He's actually just an island away.
Yeah.
My ex-girlfriend's from El Paso.
Oh.
Yeah.
Wow. Okay.
bringing
So we've
up-
got roots from all our.
Just bringing
all our
up some
colleges.
old sparks or something.
Yeah,
I'm feeling,
right.
I'm feeling my heart go pitter pat.
Are you feeling, is this a good feeling or it's like, gosh, I
It
wish
kind
I
of seems
never.
like it's a good thing.
It's all over the board.